As of today, Friday, May 22nd, 2026, at 1:36 p.m., the market is currently active and open for live trading, with the NUBURU stock price trading at exactly 19 cents, reflecting a fractional move on the session as it hovers within a tight intraday range between 18.19 and 20.60. Now, when most macro investors glance at a sub-dollar ticker like this on popular online investing sites, they immediately assume it is just another speculative penny stock burning through its final reserves before fading away entirely. But if you look underneath the hood right now, you find a massive structural shift that completely flips the standard market narrative on its head. NUBURU just reported its first quarter financial results for 2026, revealing an absolute mathematical swing in its balance sheet that almost nobody in the retail space saw coming, pulling its stockholders' equity out of a deep $15.18 million hole at the end of last year up to a positive $2.17 million. That is a massive $17.35 million clean sweep in a single quarter, completely altering the immediate liquidation risk that has scared institutional capital away for quarters. The baseline expectation for a company like this is a slow, agonizing grind downward, weighed down by compliance threats and zero product revenue. But the actual corporate reality is that they have suddenly established initial commercial traction by stringing together overseas asset integrations. This creates a fascinating tension because retail sentiment remains incredibly cautious, yet the underlying numbers are finally beginning to flesh out an actual commercial framework. If you use standard self-investing platforms or scroll through the Fidelity trading platform looking for micro-cap high-tech firms, you usually see companies trying to cut costs to survive. But NUBURU expanded its total asset base to $76.15 million this past quarter. They are attempting to pull off a corporate pivot by moving completely away from their older, capital-heavy laser manufacturing operations and stepping into a diversified defense, software, and electronic warfare platform. Let us lean into the immediate trading reality and examine the raw transactional dynamics hitting the ticker over the last few days. The trading volume has shown distinct bursts of life, hitting 19.81 million shares on the session against a broader multi-month average volume that sits around 11.62 million shares. This heightened velocity tells us that sophisticated microcap traders are actively playing these headline shifts, especially following the company's formal quarterly filing. When a microcap stock moves on double its average volume while holding its ground near 19 cents, it shows that the market is actively absorbing selling pressure from older debt conversions and finding a localized floor. If you track large-scale institutional flow on the Interactive Brokers platform, you can see that the vast majority of ownership still sits firmly in the hands of public retail investors, who control over 95% of the outstanding shares, while structured mutual funds and exchange-traded funds hold a minor 4.22% stake. This specific ownership structure explains why the price action is so sensitive to retail sentiment on the Robinhood app and other active online investment tools. Every single piece of operational news triggers intense volatility because there is no massive institutional buffer to stabilize the order book. The core of the recent price action is tied to their urgent battle with exchange listing guidelines. Just last week, the exchange issued a formal non-compliance update because the company fell short of the $4 million equity requirement for companies with consecutive multi-year losses. The market braced for a complete collapse, expecting a quick delisting notice or a forced reverse split. Instead, management dropped their official numbers, showing they have already crossed the intermediate $2 million threshold, and explicitly stated they expect to fully satisfy the $4 million requirement by the time they file their next quarterly report in a few months. They are aggressively using structured equity swaps and specialized funding agreements to wipe liabilities off the books, including a massive $8.45 million reduction in preferred stock obligations. This balance sheet engineering is exactly the kind of nuance that gets completely lost if you are just glancing at basic charts on a standard individual brokerage account without reading the footnotes of the regulatory filings. Now, let us ground this in what the business actually does and how it makes its money outside of pure corporate restructuring. NUBURU originally built its name around industrial blue laser technology, which offers significant physical advantages over traditional infrared lasers when welding highly reflective metals like copper and aluminum. However, building and scaling physical laser manufacturing facilities is an incredibly expensive game that crushed their cash reserves and led to heavy net losses. Realizing that the capital-intensive hardware game was a structural trap, management initiated a thorough corporate transformation. They completely suspended their legacy laser production line and pivoted to a platform-based operating model that relies heavily on international acquisitions and joint ventures. In essence, they are now a dual-use defense and security infrastructure company that focuses on electronic warfare, cyber defense, non-kinetic counter-drone systems, and high-margin software integrations. Look at where the first quarter revenue actually came from to understand this new business mix. Out of the $407,000 generated, the vast majority came from product sales and professional services through their newly consolidated European subsidiary, Liacon, while a smaller portion was driven by high-margin software-as-a-service subscriptions and hosted cloud applications through their Orbit entity. They are actively trying to position themselves as a software-orchestrated defense player rather than a simple hardware manufacturer. They have also entered a funded prototype phase with Maddox Defense to build mobile manufacturing units capable of producing drones and mission components directly in combat zones, targeting a massive government market. This is a complete departure from their historical business model, and it explains why the stock is behaving less like an industrial manufacturing firm and more like a volatile defense tech startup. When you look at macro sectors right now, large technology and defense names like an Nvidia stock or a Tesla stock pull the vast majority of market liquidity, forcing microcaps to fight tooth and nail for every dollar of investment capital. If an investor wants automated, diversified exposure, they often default to a robo-advisor like Schwab Intelligent Portfolios, or look for stable long-term yields through specialized Fidelity investments, including Fidelity ETFs or conservative Fidelity mutual funds. But for active traders utilizing a SoFi trading platform or looking for high-risk asymmetric opportunities on Interactive Brokers, small-cap defense names present a completely different type of calculation. The expectation was that NUBURU would show zero commercial progress while bleeding cash, but the reality is that they slashed their net loss from a staggering $16.61 million in the first quarter of last year down to just $459,000 this past quarter. They are closer to operational break-even than they have ever been in the history of the company. Please take a second right now to leave your thoughts below. Comment below how many shares of NUBURU you currently hold, or if you are entirely avoiding sub-dollar microcaps in this current economic environment. Looking forward, the path for this company is entirely binary, and the future outlook depends on a few incredibly specific catalysts. The single most important short-term milestone is securing formal authorization from European regulators under Italy's strict defense frameworks for their proposed acquisition of a 70% stake in Tecne, a specialized electronic warfare and military mobility provider. If that regulatory approval goes through, it immediately unlocks an active commercial pipeline and validates their defense platform strategy on a global scale. If it gets tied up in political red tape or blocked entirely, the entire transformation plan stalls, and the company will likely face renewed liquidity pressure. Furthermore, they must successfully maintain their public listing status without executing a highly dilutive financing round that wipes out current retail shareholders. They still possess a going concern warning on their annual financials, meaning their cash runway is tightly dependent on continuous billing collections and the execution of their near-term defense contracts. If you are evaluating this company through the lens of a self-investing account or tracking it on modern investing sites, you have to constantly weigh the structural improvements against the massive inherent risks of microcap investing. The tension here is incredibly clear. The market narrative states that this is a fundamentally broken company fighting for survival on the fringes of the public markets. The operational reality, however, shows a highly aggressive management team that has successfully wiped out millions in debt, turned their equity positive, brought initial software and product revenues onto the books, and pivoted into an incredibly hot defense technology and electronic warfare sector. It is a classic textbook example of a company attempting to completely rebuild its engine while flying the plane. To cleanly summarize what we are seeing here, the old version of this company is effectively gone, and the new platform is entirely unproven, but fundamentally healthier on paper. Investors who simply follow general retail trends on a basic individual brokerage or look for massive liquidity in large-cap equities will likely overlook the step change occurring in these numbers. But for those analyzing microcap turnarounds through specialized online investment setups, the dramatic reduction in net losses and the cleanup of the balance sheet show that the gap between what the market expects and what the company is actually executing is starting to narrow. Whether they can scale their counter-drone prototypes and secure definitive government contracts before their current cash reserves dwindle remains the ultimate test for this management team, ensuring that this ticker will remain an incredibly volatile, highly watched asset for the rest of the year. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.